Well, let's get started. Thank you everyone for joining us today. This is the second episode of the CRE Showcase series featuring Bill King. He is the SBA King of Texas. SBA financing for your next space. We'd like to do some quick introductions. I'm the host, Mary Jane Karimi. I have been doing commercial real estate for about 6 years. And prior to that, I actually worked for Dr. Pepper. I specialize in industrial, retail, development, and office. I also know a lot about biotech. So if you have any leasing, buying, selling questions, feel free to give me a call. And then we have Bill. Bill, would you like to introduce yourself?
Yes, thank you again for having me, Mary Jane. Again, my name is Bill King. I'm currently a National Business Development Officer with Dogwood State Bank. I've been in the SBA lending world for 25 years now, working in both conventional and SBA, nationwide with various clients. I am a certified M&A advisor. I got that certification when I was out on my own doing consulting a few years back, actually during COVID. I did some independent consulting for a few years, which allowed me to really see how things work in the M&A world from the other sides of the table, not just the financing. I am currently a TREC certified CE instructor. I have a course that I got set up with TREC teaching SBA lending that can get realtors in Texas 2 hours of elective CE credits. So if anybody wants to talk to me about that, we can set up a course or invite people to my next event. And very happy to get to run through this presentation today. I know we're going to be talking about different ways of using SBA financing for focus on real estate, but any questions that come up, we're happy to cover any aspect of SBA lending. Let's
Great.
go ahead and advance the
Sounds
slide
like
and then go
sounds
from
like
there.
you got it
Sorry.
all together. Let's do it.
Now, this is my legal disclaimer. I jokingly say that the lawyers made me do this. One of the things about, I do a lot of speaking, for different organizations, podcasts and different events. And whenever I'm talking about SBA lending, a lot of times I'm going to talk from my own background and my own experience. So it doesn't necessarily represent what my current employer thinks. And also, I'm not a representative of the SBA. I just know the program very well, and the program is constantly changing. So what we're talking about today, the rules might change tomorrow and be different. So this is just intended to be information to help people navigate the process and give them some insight into how things work.
Wonderful. Hey, I forgot to mention everybody, if you have any questions, please put them in the chat and then we will answer them at the end. Otherwise, just hold on to them and we can chat about them at the end.
Great. Now, usually we'll do a who's here today, but I did look at the list of people that are were signed up and were interested in the event. I know we had a mix of business owners, commercial realtors, and consultants that represent clients. And fortunately, the information that we're going to cover will be helpful for any people that are watching this now or watch the saved version that I believe Mary Jane's going to put on YouTube.
Mm-hmm.
We can go ahead and advance the slide. So first slide here is what exactly is SBA, focus on the 7A program. And, I have another presentation where I say, what is SBA and why should you care? The SBA program is a government-backed loan program. That is one misconception that people have, is that the SBA is not the lender. The actual financing is being provided by banks, and there are some non-bank lenders out there. What the SBA does is they guarantee the loan for a percentage, typically 75 to 90%. Some of the advantages of using SBA financing is that there's no balloon payment. So the loan is fully amortizing, where a lot of your regular bank loans may balloon in 3 to 5 years, and then you have to reapply, get new appraisals, and all that fun stuff. So the good thing with SBA lending is that it's fully amortized, used by over 60,000 small business annually on average. I believe the last couple of years is the largest number of SBA loans that we've had. Currently, the cap is 5 million for 7A. If we're doing a 504 that we'll talk about later, that has a higher cap. So it's typically going to be focused on deal sizes anywhere from a few 100,000 up to probably 5, 6 million. And again, it's intended for privately held companies. It's not eligible for nonprofits, and it also is not eligible for investment real estate where investment is the primary purpose. We'll talk later about some of the different structures, but you can't use this for pure rental income properties. It's not designed for that. Let's go ahead and advance to the next slide. As I had mentioned, some of the advantages over conventional is you typically have a longer amortization. One of the things that people will ask me when we're comparing SBA to conventional financing is, why would I want to use SBA? So we're going to cover some of that here. And there's usually two paths of why you use SBA. The first is you can't obtain conventional financing because maybe your loan is projection based, maybe you don't have enough of a down payment. There may be various reasons that you just can't get approved for conventional financing. But there are cases to where your business may be strong enough that you could get approved conventional, but the conventional lender is just going to require more money down from you or require a shorter amortization. Or there may be other restrictions to where we're making the case that you can't get as favorable of terms conventional as you can SBA. As I mentioned, 25-year amortization, depending on the property type, the lender might limit you to a 10 or 15-year amortization. And that we're talking about on purchasing. So for example, if you had a special use property, many times conventional lenders will limit you on the amortization to a shorter amortization, and they will typically require a little more money down because if the property is special use, it's harder to liquidate if there's an event of default. So the conventional lenders are going to hedge against that. Typically with SBA financing, your down payment will be as little as 10 to 20% down. And I'll talk later about a case where you can get away with even less than 10% if you're an established operating business. Again, I mentioned projection base is fine for SBA financing as long as it makes sense. We are still going to look at the historical tax returns of the business if it's an established business. If it's a startup, obviously we're going to look at your projections and look at your experience. And one of the main reasons that a borrower will use SBA over conventional is that you're allowed to have an under-collateralized loan. So typically, when you're dealing with a conventional financing source, as I had mentioned, their LTV restrictions are going to vary depending on the use of proceeds. With an SBA loan, it can be under collateralized as long as we've taken everything that's available. So we run into this a lot in the mergers and acquisition space to where you're buying an operating business, but the price you're paying is not covered by the tangible assets. So you may be buying, $2 million business, but the tangible assets of that business are only worth 500,000 as an example. But the going concern value of that enterprise is worth 2 million on a business valuation. In a case like that, conventional would not be an option for you, and you would have to look at SBA. And again, we also can consider startup businesses, franchises, and as I mentioned, business acquisition. Let's go ahead and advance to the next slide. Again, why SBA, credit elsewhere. One of the requirements and this went away for a few years where it changed a little bit, but it's been reinstated, is that we have to clearly show that the borrower could not have attained similar terms from a conventional financing source. And that goes to the two paths I had talked about, that either you can't obtain conventional financing or you cannot obtain conventional financing on favorable terms that allow you to preserve your liquidity and have lower monthly payments. So again, we document why in our paperwork that we have to use SBA financing versus conventional. And I covered some of this in the previous slide. So we'll go ahead and go to the next one. So we're going to talk about three basic scenarios in our discussion today to give you, some ideas of how to utilize SBA financing. Scenario A, we're going to be focused primarily on lease space, where you use the SBA loan for build out and improvements when you're having a lease space, either as a startup, maybe a business expansion, you may be buying a franchise location. We're going to talk about the advantages of using SBA for lease space. Then scenario B is going to be a discussion of a building purchase. Then we're going to talk a little bit there about 7A versus 504, which are the two main programs for this type of SBA financing. And last, we're going to talk about buying a business where the business purchase includes real estate. And we're going to talk about some of the nuances of that because there's really an interesting way to buy both real estate and an operating business at the same time that can give you some really good advantages through SBA. Let's go ahead and jump into scenario A. Under this first scenario, again, we're talking about lease space. You have a signed lease and you're now ready to do a build out. To do the SBA financing, we're talking about leasehold improvements, going to be all the walls, HVAC, flooring, build out, etc. Many times when you're getting into a space, you're not only going to need the space build out, you're also going to need to buy some equipment, get it installed. You need some working capital to get up and running, maybe some moving expenses. And the good thing about the SBA 7A program is you can put all of those use of proceeds into one loan, and then it's fully amortized over 10 years. Now, in this case where we have limited collateral, this is a good example of when a conventional financing lender either would not lend or the amortization would be much shorter. If you're an established business trying to do this, your typical amortization would be 3 to 5 years. And SBA allows us in this case to do a 10-year full amortization, and there's no prepayment penalty in this structure. So you're able to spread your payments out, get all of your construction done, your build out, and then of course buy your equipment and get your location up and running. I'm going to pause here for a second and see if Mary Jane or anyone has anyone they want to add to this before I move on, because I know Mary Jane, you have a lot of experience with leasehold improvements and build outs.
Yeah, so generally, I actually try when I get a lease, I try to get the new tenant improvement allowance that comes from the landlord, so that you actually don't have to take financing for this for building out the space itself. There may be some additional money that you'll need because they're not going to give you the entirety of what you're looking for. So that's where an SBA would come in handy. Another thing is if you have a new startup business and you're looking for a property, you may not have the capital to even sign the lease. And an SBA loan would help with that. And a landlord takes that into consideration when they're looking to lease a space to a new company. So you may actually need to have the SBA in place anyway, which is great for your business long term either way, because then you can have the financing that you need to grow. So
Yeah, those are great points. And you actually bring up something that's an interesting nuance is when you have TI reimbursement coming from the landlord, sometimes what will happen is, depending, and again, you can verify what you've run into, but in some of the cases that I've seen, the landlord will not provide that money until later. So a lot of times you'll have to finance the construction and get everything up and running. And then that TI will come in at the later date as a reimbursement or some type of credit to the tenant at a later date. So you might still need the interim financing to get it set up and get it running, but definitely having that landlord contribution helps a lot.
exactly.
Okay, let's move on. Continuing with scenario one. Again, we typically do up to 90% financing on leasehold improvements. As I mentioned, additional expenses like equipment and working capital. Again, when I'm talking with clients on these things, this is one tip that I would like to give the audience or anyone that's considering expanding your business or growing your business. When you're talking to the lender about financing, one of the things that I've seen is a borrower will come in and say, I have, let's say 500, 600,000, and we're going to get into an example here in a second. But one thing I wanted to mention before we get into that example is to also take in consideration that any money you've already spent, you can account for as part of the total project. And by doing that, that allows the lender to see that you have additional contribution that maybe they didn't consider for the total financing. Matter of fact, let's move on to the next slide and see if I have my example there. So we have this example where we have a 3,000 square foot lease, a 10-year term. We're estimating this as a restaurant build out. Again, the dollar amounts are just for sake of example. This is in line with market, I'm sure, especially out in Houston. I bet things are more expensive than this. But this just gives us something to work with. So we have a build out of about 350,000, equipment about 150, and working capital of about 100. So you have your total base project of about $600,000, give or take. And of course, as I'd mentioned, you're going to have other expenses. You're going to have, closing costs. You're going to have plans and specs. You're going to have some of the things that you probably have already invested in your business that I would suggest you let the lender know and take account for, so you can count that as part of your 10% down. In this example, we showed a rate range from prime plus two. I think we did 8.75 to 9.75. So that gives you a rate range of prime is currently 7%. So that's prime plus 1.75 to prime plus 275 range. Again, it's going to vary from bank to bank. That's just the purposes of this example, which is geared more towards an early stage business, maybe a startup or an expansion. The payments on this range, around 7,500 to about 7,800. So again, if you were comparing this example to conventional financing, if you could get conventional financing, you're typically going to have a 3 to 5 year amortization, which would make that payment significantly larger. Mary, did you have anything you wanted to comment on that before we move on to the next slide?
No, I don't.
Okay. Scenario two, this is the fun part, buying a building. So this is going to be a situation where you're going to be buying a building. Obviously, it's better, easier to do if you're already an established business. So in the perfect scenario, you're an established business, you were leasing space. Now you've received some type of notification that you're going to consider buying a building instead. So using the SBA program gives you some good examples of how to do that. Purchasing the building and land. You can also include renovations in the loan request. So a lot of times when you're buying an existing building, there's going to be some improvements you want to make. And again, you can do, if we're using the 7A program, you're going to use working capital and soft costs can be included. And it's up to a 25-year amortization. As I had mentioned earlier on, the program is not intended for rental real estate properties. So it does have to be at least 51% owner occupied. In some cases, would need to be 60% owner occupied. And the idea is that the primary source of repayment for the loan is coming from the operating business. If you have rental income, that's great. If you're renting out the remainder of the building, but the hope is that the business is strong enough to make the payments on its own. Let's go ahead and advance to the next slide. Of course, we're going to need an appraisal and environmental report. Generally, on credit, we like to stay above 680. That will vary from lender to lender. And the score itself is important, but also if there's any issues on your credit, we'll just need what they call letter of explanation, that at least if you can tell the story of what happened, if your credit took a hit, if you had some slow pays, if you had an issue, maybe if you had a previous bankruptcy. That's actually something that's a good note for the SBA forms. One of the forms that you fill out is going to ask if you have ever filed bankruptcy. And some people will check no, and we'll find out when we pull their file that they filed bankruptcy 25 years ago. And the form is specifically asking if you ever have filed bankruptcy. If it's over 7 to 10 years, it's usually not as big of an issue. We just have to get a letter of explanation. But if you are filling out that paperwork, be sure to disclose it, even if it was several years ago. But I've seen that happen on a lot of applications where people maybe saw somewhere on the internet that they thought if it's over 10 years old, it's not going to be there. It still will come up. It's just not going to be as important. So credit definitely matters. As I mentioned, you could put as little as 10% down. Any owner of the company that owns 20% or more or is considered a key management personnel will have to sign a personal guarantee. Now, that is one thing about SBA financing is that you will be personally liable for the loan in the event something goes wrong. And that is generally non-negotiable. Anyone that owns 20% or more of the company or is a key person like a CEO, even if he owns a little less, the bank may still ask them to guarantee the loan. Let's go ahead and go on to the next one. So in this example, we're doing a dual space, 60% office, 40% rental. So this is right up your alley, Mary Jane. You like to do office space deals. So we're talking about this project. Purchase price is about $1.5 million. We're saying about 400,000-ish in renovations and about 100 in equipment, just to give us a round number of $2 million. One of the things when I was doing this presentation that I didn't do because I didn't want the slides to be too messy is I didn't break out the down payment percentages and to get down to the net loan amount. We're just assuming for the cases of this analysis that the 2 million represents the loan amount. So it would be, let's say, 2.2 total project and you put 10% in. One of the good things about a case like this, and this is, we'll talk a little bit on the future slides where we're comparing 7A to 504. But if you're an existing operating business and you have been leasing and you're established, let's say already 3 to 5 years, and you're a profitable company and you were renting and now you're going to buy a building, it is allowable, and there are lenders that will provide up to 100% financing in that kind of case. The SBA allows for it, but not every lender is going to do that. And that does give me the opportunity to explain a misconception about SBA lending. When I'm doing in-person presentations, a lot of times I'll have a big whiteboard behind me, and I'll set the whiteboard. The outline of the whiteboard is the 400 something page SBA rule book that tells us what we can and can't do. And that represents, the parameters of what any lender can do. But all lenders are going to work within those parameters, and they're all going to have their own credit box. So what will often happen is, let's say you go to a bank that maybe has a tighter credit box and they deny the SBA loan. That doesn't mean that SBA has in fact turned it down if it's eligible. It just means that that lender was not comfortable using the SBA for that loan. And I spent 5 years as an independent consultant where that's all that I did was take loans that one bank wouldn't do and take them to someone else who would. And in the SBA world, a lot of us are friends. I know probably hundreds of SBA lenders nationwide, and we all have different things that we like and different things that we don't like. So we even internally will refer deals to each other where we're just trying to help a borrower or a referral partner out. Like I had a deal the other day that we couldn't do, that I know that one of my friends that's more aggressive in that space is going to be able to help the client. So just because you get turned down at one place does not mean that SBA has specifically turned your deal down. As a matter of fact, with most cases, especially preferred lenders like us, we do a great deal of the underwriting before we ever even talk to SBA about the deal. So the actual SBA itself hasn't seen the loan until you're much further along. So just keep that in mind. Don't be disappointed if for some reason one bank or two banks can't get comfortable with your loan. There are several lenders out there that might be willing to do it. And that is a big misconception that I'm glad that we're able to cover for people. And I know we'll have some Q&A later where we're going to go over some of the things that are common misconceptions of the program. Mary Jane, do you have anything you wanted to add on this one before we move on to the next stage?
No, but Bill, I did want to ask. So you on this slide, you have 8.75% APR and 9.75 APR. Are those
Uh-huh.
very common percentages, or is that the percentage of what it is right now,
No, that's
generally?
great. That's a great question. And so that is actually a common pricing range for these types of deals, which is pretty much anywhere from prime plus 1.75 to prime plus 2.75. And many of your SBA lenders out there, particularly on the 7A program, are going to price in that range. If it's a stronger credit, it may be a little lower. If it's a weaker credit, the highest it'll typically go is prime plus 3. So that would be about 10% in today's rate environment. But it is usually most lenders are going to provide variable rates, and some will not. Some will do a fixed rate as well. I know if there's listeners out there that are other lenders say, hey, we do fixed rates. There are some lenders that do fixed rates, but the vast majority that you're going to be dealing with are going to reprice periodically, quarterly or every few years. And they usually use prime as a base. And to your point, you can in fact get lower rates, particularly with when you're purchasing real estate, because when you have that tangible collateral and you have that longer amortization, the risk profile is lower for the lender, so they may sharpen their pencil and get a little more aggressive. So I've seen cases where, some lenders will go all the way down to, prime plus one, and maybe even lower than that if it's a specific scenario with a well-established company. And I'm glad you mentioned pricing, because when we get into the next couple of slides, when we compare 504 to 7A, we'll talk about how 504 can be a good long-term pricing vehicle for people that are more interest rate sensitive than having the lower down payment or wider use of proceeds.
Perfect.
Let's go ahead and advance. Perfect setup. So talking about pricing, as I had mentioned, the 7A program is what we call the Swiss Army knife of SBA lending. It's a little bit faster than 504, fast for SBA. I mean, I know that the SBA lending is known to take a little bit of time, and we're going to cover that later of how to try to shorten the time that it takes. But there's a lot more flexibility in the 7A program because you can have multiple use of proceeds all in one loan request. One example of that is for the example we were talking about earlier, if at least 51% of the use of proceeds when you're using a 7A loan is real estate focused to purchase the real estate, and the other use of proceeds are equipment, working capital, various other things. You can amortize the whole loan over 25 years as long as the majority of the money is used to purchase the real estate. So that is a time when 7A can definitely be a great tool because you're stretching the amortization for all those other expenses that would usually be a 5 to 10 year amortization. Switching over to 504, 504 is a separate SBA program that's geared specifically for real estate purchases. So you can't mix in other use of proceeds with that. If you were going to need working capital and equipment, you would need to have a separate loan using 7A for that. And the 504 piece would just be focused on the real estate portion and the real estate improvements. Now, when you do a five, and again, I can do a whole presentation just on 504 because this gets a little complex, but I'm going to just give you the highlights of it real quick. When you do a 504 loan, let's say the initial loan, let's say, is $2 million, and it's going to be split where the SBA portion, I'm sorry, it's going to split in two loans. The bank is always going to have 50% of the total project. That's the requirement. It's always going to be 50, 55%. The total project will be the bank loan. Then there's the certified development company who is going to come in and do the SBA guaranteed portion. And the bank is going to help you set all this up. So don't get too alarmed by all this. The bank will walk you through it. But when I bring in the certified development company and they do their approval, their portion, the second lien, is going to be 100% SBA guaranteed. And that is then sold on the secondary market. And that is what they call a debenture. And that's where you're going to have a long-term fixed rate. So typically your structure of a 504 loan is your first lien, the bank loan, being it's only 50% loan to value, the bank is going to be a little more aggressive on that. So that's Mary Jane, where you're going to have more of a longer term fixed rate deal. So you may have more like a 6-7% rate on some of those. And typically the bank will fix it, for 5 years at a time is what I've typically seen. A bank will, fix it for 5, they'll reprice it for another 5. And then after 10 years, they may balloon the note, depending on who the bank is. Some may fully amortize it. But they are typically going to have a 25-year AM, but the repricing will be every 5 years or so. And again, it's going to vary from bank to bank. The debenture portion is a little more straightforward. That is going to be fully amortized over 25 years. And right now, the debenture rate on 25-year paper is just above 6%. So you're going to have what we call a blended rate. Your first rate of the 50% loan, let's say maybe 7%, and the debenture rate may be 6%. So when you combine them, you're in between 6 and 7% long-term financing. But again, the use of proceeds has to be primarily for the purchase of the real estate. And there is a prepayment penalty. Usually the bank will have a declining 5-year prepayment penalty, and the debenture will have a 10-year prepayment penalty that's also usually declining. So just know that if you are going to lock into using 504 as the vehicle, it's intended for a building you're going to hold for a little bit longer. And the projects, when you're using 504, can be a little larger. You can go up to 10, 12 million in the example here. I've seen some where they go even higher. And the time that they would go higher is because the certified development portion can be less. So if it's 40% of the project where you have like a straightforward office building, and it's an established business, you're probably going to be looking about a $10 million, $12 million deal. Let's say that it's a startup business, then usually the certified development portion will go from 40 to 35% that they're willing to put in because of the additional risk of the startup. If it's a special use property, it will then go down another 5% to 30%, which is why I have the range of 30 to 40%. So that variance, what changes is how much the second lien CDC loan is. And again, it varies on property type and whether the business is considered a startup. And all of these are case by case, but those are the general parameters of how 504 works and compared to 7A. And I'll pause for a second, Mary Jane, because I'm sure if you have any questions, there's other people in the audience that might have questions too. Okay.
I can't see the question screen, so if you do have questions, just put them in the chat, and we'll get to them at the end.
Okay. Did you have anything you wanted to add to this, Mary Jane, before we move on?
Nope.
Okay, great. Let's go to the next slide. Now, this scenario, 504 is not eligible. This can only be done 7A. So what we're talking about here is buying a business that includes real estate. So oftentimes when you're buying an existing operating business, you'll also be buying the real estate that it sits on. And when you're doing that, your loan may be separated into two different loans, or it may be just one loan. And it depends again on if the real estate is more than 51% of the project. If the real estate is more than 51%, that gives you the ability, even in buying a business, to amortize it over 25 years. If the real estate is less than 51%, then the lender will split it into one 10-year loan for the business acquisition piece and a 25-year loan for the real estate piece. And again, in this example, you're going to have equipment, FF&E, inventory, working capital. When you're dealing with a business acquisition, there's going to be a goodwill component. That's where we were talking earlier about the enterprise value of the business that's not covered by tangible assets. So, and again, we'll get a business valuation to make sure that the going concern value of that business does support the price, but that value is considered intangible. It's based off of what the cash flow is the business can create, not off the tangible assets. And let's go ahead and move to the next slide to see if I have an example here. I think I do. No, we went straight to franchising. So on the previous example, we would have a situation where, like I'm working on one right now, where I have about a $5 million purchase and $3 million of the value is real estate and $2 million is the enterprise value of the business. So your total project is $5 million. In that case, 60%-ish of the use of proceeds is real estate, and the rest is the business acquisition portion. So we are working on a loan request for a 25-year amortization on that. We're requiring about 10% down. So the loan amount's going to be about $4.5 million, give or take. But because we know that 60% of the project is real estate, we know we can do that on a 25-year amortization. So where that helps you is a lot of times when you're doing business acquisition financing, there's a reason that the seller is selling. Many times they should have retired 3 to 5 years ago, so maybe the most recent financials aren't as strong as they could be. And maybe you, as a buyer, are coming in, you have some plans to improve the cash flow of the business. So it allows you, in a case when you're buying real estate along with the business, to have a longer amortization. So the impact on the cash flow is lower, which will allow you to have a higher chance of getting that loan approved, looking at the historical cash flow of the business. Because one of the things you'll see with most business sellers is they're trying to keep their taxes as low as possible on their business tax returns. And that's what we have to use as an SBA lender, are the business tax returns, to justify the ability for the business to be repaid from the income of the company. So there will usually be some adjustments to that from the sellers, other expenses that they're running through the business. But the point of that is, in a case like this, where you're buying real estate and business together, when you're able to have a longer amortization, it allows you to get a larger amount of deals approved because the payment expectation is lower. And next, we're going to talk about the exciting world of franchising. Now, one of the neat things about franchising, where you'll have people that either are retiring from corporate America or they're trying to get into business, but they don't want to do a pure startup, and maybe they're not going to buy an existing operating business from somebody down the road, but they do want to buy into or get into a franchise concept because you have something that's proven and producing. With the SBA, we have a list of what we call approved franchises that's been reinstated this year that provides franchises that are in the SBA approved list, that they're like, okay, we've dealt with these companies before. We understand their franchise, and there's a different scoring model that tells us if a franchise is strong or just getting started. Like you have what's called emerging brand franchises, which are harder to finance than, let's say, McDonald's at the other end of the extreme. There's a lot more to franchising than just restaurants. That's just an example. You have automotive franchises, you have various types of franchises out there. And what I would say in the continuum, though, is the better established the franchise is and the stronger the franchise is, the less dependent the SBA lender is going to be on your personal experience. So, for example, I have a deal I'm working on right now that is an emerging brand franchise. Well, being it's emerging and the franchise itself is not very strong, we're looking more at the individual's strength and their relatable experience than I would if it was a more established franchise that had a stronger training program. But the good thing about franchising versus pure startups is that we are working with a proven system, so it has a higher chance of getting approved than just a straight startup. Your term is typically 10 years if it's lease space, or you can also do any of the things we talked about earlier under a franchise model where you're buying real estate along with the franchise. But typically they're 10-year amortizations. You're going to have whatever the franchise startup costs are if it's a pure startup, or you could be buying an existing franchise location. I have a deal right now I'm working on out in Florida, actually, where my client is buying an existing franchise from somebody that's selling it. And so that is another thing within the franchising world. You still have that additional strength of the franchise system being behind the deal, in addition to just an individual that's selling their company. So there are a lot of deals that are done in the franchise world. Again, we deal with them nationwide. And if Mary Jane, if you or any of your viewers had a question on a specific franchise, you're welcome to reach out to me. I actually have a whole directory that we have access to as preferred lenders that we can look up information on a franchise to help them. Again, they're going to do their own analysis, but I can provide some extra info to help them decide what direction they want to go with the potential franchise opportunity.
Great, thank you. I do have a question actually.
Yes.
If it is a strong franchise, will the new owner, have to personally guarantee the loan?
100%. Yes. The one thing in the SBA world that I will make abundantly clear, and if one of my other fellow SBA people want to contradict me on this, I'd love to hear what their thoughts are. But I've never had a case doing this 25 years that the owners that own more than 20% were not required to guarantee the debt. And one of the reasons why, and actually I'm glad you asked, that's a good question. One of the reasons why that's important is, as I mentioned at the very beginning, the SBA is only providing a guarantee to the lender. So think of the guarantee as an insurance policy. So whenever you make a claim on an insurance policy, what's the first thing that happens? The insurance adjuster comes out and they check to make sure everything is correct and that they decide whether or not they're going to pay that claim. Same thing with the SBA financing. So let's say, Mary Jane, in your example, we had a stronger franchise. And because of the franchise strength, the lender went ahead and took that extra risk and they waived a guarantee requirement of an owner that was, let's say, 30% of the business. And let's say it was $1 million deal just for simple math. And that deal goes bad. And the lender is going to lose, let's say they liquidate all collateral, they're going to lose, let's say 500,000 on that deal. And then they go back to the SBA and they say, hey, we want our guarantee, pay us 75% on this loan. And then the SBA's first thing they're going to do is they're going to come back and they're going to audit the complete file and the whole history. And they're going to ask the question, I see that you waived a guarantee requirement on this owner that was more than 20%. It is entirely possible that the SBA will deny the guarantee over that, or they can limit the guarantee and say, you know what, we're not going to give you 75%, we're going to give you 30%. So whenever you go outside of what the policy requires of the SBA rule book, you put yourself at risk, especially as a preferred lender, of them coming back and second guessing what your decision was and that impairing your guarantee that you should be paid. So that is
Gotcha.
one of the reasons why some of these rules are hard and fast, and you're generally not going to get any exceptions to them. But that's a great question. I'm glad you asked that. Thank you.
We do have to speed it up since we started a little bit late, but just wanted to give you a heads up, Bill.
No, thank you for that. This is just an approval timeline guesstimate, and this we can run through really quick. I kind of look at the financing process as you got these stages. Your early stage is what we call the pre-screen process. That can go relatively quickly if a loan officer gathers the information together. They understand, yeah, there's enough information here. We think that there's a good deal. They're going to go into week 3 and 4, which is getting an actual approval with the underwriting department. Week 5 to 6 is going to be kind of going through clearing some of the conditions for approval. And the last few weeks are getting the deal actually closed and funded. This example, we're talking about a 60-day process, which is pretty reasonable for your typical 7A. It can be a little shorter or it can be a little longer, depending on if there's any complications. What I would say to do from a borrower's perspective to make your life a little easier is just be responsive when they ask for information. Just get them what they ask for because they're not asking for their health. And sometimes what will happen is when you go from one stage to the next, you'll be asked for some of the same information again because it didn't get transferred over. rather than getting frustrated, if you have it available, just send them what they're asking for and make sure that it clears the item. Because what usually slows things down is all that back and forth between the borrower and their representatives and the bank getting all the information they need to clear each stage. So that'd be your easiest way to speed it up. And as I mentioned in my disclaimer here, the timeline is in general and it can vary. It can be a little faster or slower depending on the situation. Key takeaways I'd like for everyone to have from this is the leasing example, purchase example, business acquisition example, franchising. Again, we talk about starting or existing, and then just estimated timeline. You can help shorten that if you're able to just provide the lender what they need to move your deal along. And I think we're almost done. What do we have next here? Yep.
All
So
right.
here's our contact information for me, Mary Jane and I. Easiest way to get me is on my cell or via email. I'd love for people to connect with me on LinkedIn. I have about 12,400 LinkedIn contacts. I do a periodic newsletter talking about SBA financing and would love to connect with anybody and provide any additional insight that I can.